In this next set of slides, we're going to do product costing. This is going to take more than one video to work through, so let's get started. I've put out the relevant accounts, and you'll notice that mostly on the asset side, I have various inventory accounts. These are all inventory. Raw materials, overhead, finished goods inventory, and then the work in process accounts are reflecting what's called job order costing, in the sense that we keep track of costs for various jobs. So here we have jobs number 1 and 2. I'm also going to show an income summary account because we might need that later on. I'm not going to show a bunch of liability accounts or the like. I'm just going to focus on the debits and credits as they affect the inventory accounts. Now, if we purchased inventory, we would have a debit to raw materials, let's say $15,000, and a credit could be either to cash or accounts payable, just to keep everything balanced. But since we're not preparing a balance sheet, I'm not going to worry about that. Now we're going to add materials to various accounts. You'll notice that we have debits and credits here. So here we've taken $3,000 of raw materials and added it to manufacturing overhead. So debit, overhead, credit, raw materials. Then we've taken $4,000 out of raw materials and put it into job number 1, credit raw materials, debit work in process. And we've taken $2,000 of raw materials and put it into job number 2. Once again, debit work in process, credit raw materials. You'll notice that the raw materials balance decreases because the materials have been transferred to other accounts. Let's add labor. And we have indirect labor, so this of $7,000. So this would be indirect labor. And over here we actually have direct labor. So the difference is that both these types of labor are part of the manufacturing process, but for the $14,000 and the $9,000 is labor that you could trace directly to the individual jobs, whereas this labor might be labor that's shared between the jobs. It could represent supervision, or it could represent a manufacturing process that is required to make the jobs, but is not specific to the individual jobs, say maintenance. Now, overhead costs need to be assigned to product. So we have $10,000 of overhead. These are product costs, and they have to go into the product. We just have to figure out how to do that. In this video, I'm not going to say exactly how the numbers are determined. We'll do that in a different video. But let's assume that we somehow decide that $4,000 worth of overhead should be transferred to job number 1, and $6,000 of overhead should be transferred to job number 2. Notice now that all of the overhead has been allocated to the jobs, and that's required by generally accepted accounting principles. Since the overhead is a manufacturing cost, manufacturing costs have to end up being assigned to products. Now, when a job is completed, it goes from work in process to finished goods, and this is called cost of goods manufactured. In this example, both of the jobs are completed, so both of them go to the finished goods account. And notice that the zero balances here don't mean that the jobs have zero balances. What it means is that the work in process for those jobs has zero balances. Remember that this is still job number 2, and this over here is still job number 1. It's just that those jobs are now completed. And so they're in finished goods rather than having a label that says work in process. If a job is sold, let's say job number 1, then the cost is transferred out of finished goods account and goes onto the income statement as cost of goods sold. So let's just call that cost of goods sold. So notice that we can actually trace the cost for job number 1. So work in process, finished goods, and then onto the income statement. So this is what is often called a cost flow. Product is manufactured. The costs first are accumulated in work in process. When the job is completed, the costs are transferred to finished goods. and when a job is sold, the costs are transferred to the income summary account.